Okay, this is a brief introduction of Project 1, the accounting cycle project. So the first worksheet, BS0, we're going to have the balance sheet for this company, Captain Fishing, for the fiscal year ended December 31st, 2023. Okay, so this is the last year's balance sheet, which provides the account balances for 2024, and they become the beginning balance for 2024, all these accounts. So next we were given many transactions, and we're going to record these transactions in journal entries first. So we're going to record journal entries in this worksheet. In two types of journal entry, we have general journal entries and we have adjusting journal entries. Right, so adjusting journal entries will be recorded after we record these general journal entries. Alright, so I'm not going to cover all these journal entries, but let's talk about some important ones. First, the company sold merchandise on account to client, term 2 of 10 and of 30. Okay, this is a typical credit sales transactions. Right, so let's record the credit sale transactions. Journal entries, credit sales transactions. We can increase our accounts receivable. Okay, then we're going to credit sales. Right, so the amount 8,800, 7,500 together that's 16,300, and you can record a sub account for those two clients, but we don't have to. But if you do that, that's better. But I'm not going to record the sub account for account receivables, so I'm going to record that directly, and this will be the same for sales. Alright, the reason I'm recording two columns and numbers separate from the accounts, that's easy to be used, okay, when we do the trial balance and the financial statement. But that's not all for sales transactions, because for sales transactions we need to also record the cost of sales. So the cost of sales is we're going to increase the cost of goods sold. And meanwhile, because we sell, right, we're going to reduce our inventory. So we credit inventory. So this journal entry is on the revenue side. This journal entry is on the cost side. So how do we find cost of goods sold? Then this information is very important. Number 11. The gross profit margin is 0.6. And the gross profit is sales less, right, cost of goods sold. Gross profit equals sales less cost of goods sold. So if the gross profit margin is 0.6, right, gross profit divided by sales is 0.6, then for every $100 sales, right, the cost of goods sold will be $40. Okay, so our cost will be 40% of the sales. Right, so see, this is how we determine the cost of goods sold. Right, so yeah, better to add a column to record a transaction number. Okay, this is for transaction 1. Right, then we have transaction 2. Transaction 2 is right? It's our purchase, right? We purchase inventory from vendors. Yeah, so I'm not going to record it. You should be able to record transaction 2, right? It's a credit purchase. So we're going to credit our account payables. Number 3 is we receive payment from client. Sales on account after discount period has lapsed. So no longer provide discount. So we're going to receive a cash, right? And we're going to credit account receivables. The total amount is $7,200. That's easy to record. Alright, so let's look at number 4. Number 4, it says, right, we send checks to vendor. Right, we're gonna for this vendor, we send this check. We're gonna send this amount less 3% cash discount, and this amount for this vendor is 2% discount. So we are paying our account payables, and meanwhile we were given cash discount for prompt payment. Okay, so we're gonna record these transactions. Let's calculate discount. 3% of this discount and 2% of that discount, and the total discount equals $458 in this case. Okay, so let's record number 4. Number 4, we're gonna pay our vendors, so we're gonna reduce our account payables. And we're gonna pay cash, so we credit cash. Account payables total amount is okay, but we're not gonna pay the full amount cash. Okay, we just calculate our discount will be $458. Okay, because we enjoy discount when purchasing inventories. This discount is gonna reduce the cost of our inventories. Cost of inventory has been reduced. We credit inventories. So the cash payment is this payables less the discount amount. So that's the total cash we pay. Alright? And number 5, we issued credit, okay, to Fisher for merchandise return. Remember Fisher, we just sell something, right? We sell something to Fisher. Now they return some of those inventories. So let's record the sales return. Right, so the sales return is going to reduce our sales. So debit sales return, which is a contra sales or contra revenue account. And meanwhile, we're going to reduce our account receivables from Fisher. That's 550. Because Fisher has returned those inventory to us, so we're going to increase our inventories as well. That's a cost side, right? Cost side. Increase our inventory and reduce our cost of goods sold. And the amount, we just calculate 40% of the sales amount will be inventory. Right, that's number 5. Next, number 6. Number 6, we paid off balance for the purchase made on January 12th. Okay, this is January 12th. And on January 21st, we paid. Okay. So be careful, because we paid within 10 days of the purchase. We should be given the 1% discount, right? 1/10 if we pay within 10 days. we enjoy 1% discount. So when we make this payment, okay, when we this payment, we're not going to pay the full amount. Remember, we have 1%. We have 1% discount from the transaction. Okay, and we know we have seen the journal entries already. The discount is going to reduce our cost of inventories. Number 7, right? Receive payment in full. Okay, so that's a typical increase of our cash, reduce account receivable. So no question about it. Number 8, you paid rent $8,400 for 2 years term, starting July 1st, 2024. Okay, this is a typical prepaid rent in which we increase an asset called prepaid rent and reduce another asset cash. So number 8, 7, 6, 7. Number 8, we're going to increase prepaid rent, which is an asset. Okay, and credit cash. $8,040. Okay. Number 9, the company CEO paid $49,000 from her savings account to purchase a car for personal use. Okay, this number 9, it's CEO's personal transactions. It has nothing to do with the corporate transactions. So number 9 will not be recorded. Okay, will not be recorded by the company. Right, number 10, the company paid cash for office supplies and expense immediately. So this is right, we're going to incur the supply expense, reduce cash, right? That's easy to record. Number 11, it's about cash dividend. Cash dividend declared and paid to stockholders on June 23rd. So, right, it almost really 10 days after announcement, 11 days after announcement. So we have 9, 10, 11 is issuing dividend. So I can combine the two transactions together. So this is going to increase my dividend, which is is going to reduce my retained earnings or equity account, and then reduce my cash. This is the amount of dividend we have paid. Right, number 12, issued a note to the bank for cash on June. This is a typical borrowing transactions in which we increase cash and we credit notes payables. So that's easy to record. Number 12. Number 13, purchase merchandise again. Okay, that's a typical purchase, credit purchase. So we're not going to talk about that. Okay, number 14, we issued stocks. Okay, issue stocks in exchange of a land with a fair value of $16,000. So this is an interesting transaction. So let's talk about number 14. Number 14, we're going to increase an asset, land, right? And on the other side, we're going to increase our equities because we issued stocks. So the value of the transaction is determined by the fair value of the land, $16,000. All right. So I'm going to skip 12, 13, and we have 14 now. 14, we're going to increase the land by $16,000. And I'm going to increase my equities So we start with common stock account, which is going to record par value from issuance. Okay, and the par value is $10 multiplied by the number of shares issued. That's the total amount we're going to credit to common stock account. Okay, and the difference between these two is going to be recorded in the paid-in capital account from common stock. Or sometimes it's also known as the additional paid-in capital account. Additional paid-in capital account. Right. Additional paid-in capital account. Number 15, that's a regular transactions. Returned merchandise to seller. So if we return merchandise to seller, it's going to reduce our account payables and also reduce our inventory for this amount. So that's easy to record. Number 16, right? Sold merchandise again, so that's a regular sales. Number 17, paid off the balance to the vendor. Okay, so no question about it. Make sure that nothing happened to the discount, right? So you can verify that we have passed the discount period, which is 10 days after this purchase. If that's over 10 days, I don't count the discount anymore. Okay. So number 18, paid utility expense. That we increase utility expense, right? Reduce cash. And number 19, right? The company paid off its balance. Okay, so you're gonna verify what's the balance for this company. Is there any discount involved? Okay, then we're gonna debit cash and credit account receivable. That's easy. But 20, paid off for merchandise purchased last year. So obviously there's no more discount. We debit account payables, credit cash. Alright, so number 21, we paid off note payables issued last year and associated interest. This amount includes 1,800 interest payable on the balance sheet. Alright, so this is interesting journal entry, so let's talk about it. We pay off note payables. So we're going to skip much. No, we are on 21 now. If we paid off our notes payables, we're going to debit notes payables. Okay, and the total amount that's given. Right, we paid off these note payables. Meanwhile, we need to pay interest. The total interest will be $6,000, among which $1,800 has been recorded account payables already. Okay, meaning we're going to pay $6,000 interest, but we only record the difference, right? $4,200 interest expense. $1,800 interest expense has been accrued in last period. Alright, so we're going to debit interest expense. Just calculate $4,200. And we're going to reduce the interest payable. Which is accrued last year. So we credit cash, right? The total cash we paid is the sum of all these amount. Right, that's 21. '22, it's cash sales to other retail customers. Okay, if it's a cash sales, right, we debit cash, we credit sales. Okay, don't forget to record the cost side in which we debit cost of sold, right? We credit inventory, just like we did for other credit sales. So that's cash sales. Number 23. 23 is a sales office employee earned, right? This is a salaries, right? Of which $2,480 remain as payables out to the end of the year, right? So that's we're gonna record the salary expense total to $24,800. Okay, and we're gonna credit cash. That's 23. Right, we're gonna debit salaries and wages expense. We didn't pay them all, among which we have a payable. Right, we have a payable. And meaning we must have paid cash for the difference. Right, so we paid cash 22,320 and 2,480 remain as payables, which will be paid the next period, very likely. And 24, that's received utility bills and paid off next year. Okay, this is the time we use accrued accountings. We received the bill, we haven't paid anything, but this bill is for this year, so we have incurred utility expense 1,350, and we incur utility payables for this year 1,350. We're going to pay this amount the next year. Okay, number 25, we pay 5% interest on bonds payables. So you may wonder where we have the bond. Right, the bond is available. Look at bond, long-term liabilities, right? Bond payables, $300,000. That's total bond we have, and we apply 5% interest on it. That's going to give us $15,000 interest expense. So we debit interest expense, $15,000, and credit cash. All right, so we finished all the general, regular transactions. So let's talk about adjusting entries. By the year end, we need to make adjusting entries. So what are the information we have? Depreciation expense. Okay, 11,780. So first we're going to record the depreciation. Right, we debit depreciation expense and credit cumulative depreciation. That's easy to record. The company estimated, number 2, the company estimated that it will pay federal income tax. Alright, so this is accrued accounting. We expect to pay, so we have incurred the expense. So we're going to debit income tax expense, this amount, and the credit tax payable, this amount. That's number 2. Number 3, after physical count, the company decided the ending inventories was 41,179. So here we have a typo here. The number is incorrect. After physical count, inventory we have is 25,520. 20. Okay. So our ending inventory must be this amount, and it will be this amount. And number 4, unearned revenues was decreased. So if unearned revenue was decreased, right, we debit unearned revenues and credit sales revenues. It's increase our sales revenues. And number 6, company expends all their supplies purchased during the year. Right, so we're going to check what is the total supply amount. Supply amount. So do we have any supplies? Right, we don't have any supplies at the beginning of the year. And during the year, yes, in number 10, right, we purchase office supplies expense immediately. So we already did expense supplies. So there's no more additional information here. No insurance policy was effective during the year. So all the insurance, prepaid insurance, will remain as prepaid insurance. There's no more insurance expense. Okay. Okay, the company use gross method, record purchase sales. Now we already did that. The company adopts perpetual inventory systems. We already did that. Okay, and the company has 0 balances. So this is the information we have, but it's not going to change our journal entries. We already did that. The gross profit margin information, we already did that. Right. So in addition to these information, I believe we have some prepaid stuff to expense. For example, we have prepaid rent. Okay, and that must be expensed. So it's going to increase our rent expense, reduce our prepaid rent. And I forgot to mention the number. Right, number 4, I forgot to talk about. Based on historical data, bad debt expense is about $1,350. This is a bad debt expense that we need to record a bad debt expense. Number 4, when we record a bad debt expense, so that's for adjusting journal entries. Number 4, if we record a bad debt expense, we increase bad debt expense. Okay, that's the information we have. Okay, and be careful, we're going to credit. Okay, I'm going to record here. We're going to credit the allowance for that account, which should be available in the previous year's balance. Right, the allowance start of account will be credit. Yeah, actually I can just link that account. Probably not, right? Alright, so that's number 4. Right, so I think that's pretty much we have for the journal entries. Be careful, there's a typo for end inventories, which I'm going to update the worksheet as well. Alright, so we have all the journal entries. So what's next? So next, which is very important, we're going to post journal entries to the ledger. A ledger is a book holding all the accounts. Okay, and some of the accounts we have many increase and many decrease, and we want to have a clear ending balance for those accounts. which will be used for the next step. For example, right, we have cash account. In fact, we can establish all these accounts in the ledgers, which you may do that, but many of these accounts we don't have any transactions, so nothing to update. But some important like cash, receivables, inventory account, we have many transactions, right? It's better to show the increase or decrease in the ledger. For example, I'm going to build a cash T account, right? Cash T account, and all here are debit side, right? And I have a credit side. Okay, so I'm going to start with just to show you how to start with these posting. So we're going to start with the debit side is from the previous years or become the beginning balance for this year. So this is the first debit. Okay. So I'm going to go back to the transactions to find all the cash. Okay, for example, number 4, we have a credit cash. Okay, and this will be posted to my credit side of the cash T account in the ledger. Right, so I have another credit, identify another credit. So right here, and another right here. Okay, just to show you, so journal entry is not complete right here. If you have a complete list of journal entries, you should identify all the asset debit, all the asset credit, and then you're gonna have ending balance for sure. It's on the credit side. Okay. So we're going to do the same thing for accounts receivable, another important account. We're going to do the same thing for inventories because there's so many debit and credit. It's not easy to figure out the ending balance for those accounts. Right? In fact, for those important accounts, we're going to establish T account and post all the debit and the credit amount and then update the ending balance. Okay, that's this step we call the posting. After we post all the transactions, okay, all journal entry or accounts will be updated, and we're going to have updated ending balance for these accounts. Now this time we're going to move to the trial balance. Trial balance is a place we can post all the debit and the credit ending balance from the ledger T account. Okay, then we have the total debit and total credit to show whether they are balanced. For example, if we have a cash ending balance, I'm going to post from the cash T account. Okay, just for example, I have this cash ending balance. This is obviously is incorrect, but just give you examples. I just post, okay, the numbers from the ledger to the trial balance. So I'm going to do these for all other accounts. For all the other accounts, that's asset, liability, equities, followed by revenues and expenses account. So by the end of the day, the total debit must equals total credit. That's a trial balance. And once we finish the trial balance, we can get income statement easily. Why? Because if you look at the component here, right, we have all the revenues, expenses. Just copy these account and format this account a little bit. Okay, we're going to have the income statement. Then the shareholders' equity statement. Okay, follow the format. We're going to get the shareholders' equity statement, which shows the change in equities. Right, that's the previous return earnings, right, plus net income divided dividend equals any return earnings. So we update return earnings in this shareholder equity statement. And then finally, that's a balance sheet. But that's easy because we have all the assets, liability, and equity account. Okay, right here. Right here. All these are balance sheet items. Just format these account carefully, and we're going to have the balance sheet. And don't forget to update the retained earnings. Okay, the retained earnings amount has been updated in the shareholder equity statement. Alright, that's it for the accounting cycle project.